Hello everyone, welcome to this video. In this video, I'm going to share some points regarding the trends in the forex market. I have received some mails from my trader friends and they have mentioned how they lose money in the forex market. And when I looked at their chart, the one thing I found that some of the mistakes they're making are they are not sure how to capitalize on a trend. They make some mistakes which are something like which should be and which can be avoided very easily by the traders. And once those mistakes are removed, the same trades which are ending in loss or which are ending in low profit can end up in having very high profit. Uh, Let me mention some of these mistakes that the traders are making. Now, this is the Euro USD chart. As you can see that the market is going down. It has a pullback, then goes down again, has a pullback, then goes down again. So this looks to be a very significant downtrend. Uh, so, so first common mistake that traders are making is that if if they are in a trade, they end it very prematurely. For example, if you look at this particular candle, um, as you can see, the market was in a downtrend, then it had a pullback. This is a blue candle, which means the market is going up, but it is followed by two dojis, doji 1, doji 2, and then a bearish candle. So this is a good area where we can imagine that the downtrend has resumed again. So for example, now if a trader places a trade here, they they close the trade prematurely. They open the trade here, and as soon as the profit reaches, for example, 10 or 15 pips, they're closing the trade. They're just scared thinking that the market can reverse and whatever the profit they have made in the trade can also go away. So this is the first mistake they're making, and the reason for that is that they don't have the money management principles applied. For example, if your trade has opened here and your stop loss is somewhere here, then at least you're certain that if the market reverses, the maximum it can go is reach here. Of course, it will take away the profit, but if the trend continues, then the stop loss or the other money management principles that you apply, it will make sure that some of the profits are intact even if the market reverses. For example, if the market reaches here and from here it reverses, then I'm sure with the money management principles, the stop loss could have been moved from here to here, which means at least you will end up in 10 or 15% profit. If you are in a trade and you are taking advantage of a trend, then it is very necessary that you keep the trend open till the time the trend is continuing. Unless you're in scalping, scalping means a fixed profit less than 15 or 20 pips, and as soon as your profit target is achieved, you can close the trade. But if you're in a day trading or swing trading and you're in a trade for a longer term means could be 1 hour, 2 hours, 4 hours, a day, a week, then you must make sure that you're taking advantage of the complete trend. That is the first thing. The second mistake that the traders make is that they open the trade in no man's land. For example, now we just took the example of this particular reversal. Now imagine that a particular trader has missed this particular point. He missed this particular candle, or for example, he was away from his uh, uh, trading station, or his, for some reason he didn't catch this particular reversal, and he saw at this point that the market is reversing, and he tries to open the trade here. Or for example, it opens the trade here. Now this is a no man's land. It has some risk associated with it, because if you are opening a trade here, where are you going to place the stop loss? Is your stop loss going to be here, which is also a point where the market is trending downwards, or your stop loss will be here? If your stop loss is here, then this entire distance is very large. It is not, unless you are expecting the profit to be somewhere, profit point to be somewhere here. This is a very big stop loss. Now, the other risk is if you are going to be here, there's a good enough chance that the market can reverse from here, because the market is going down, then going up, and then going down. You don't know what is the bottom here. And similarly, if you look here, if the particular trader missed this particular candle and opens a trade here, thinking that the market will continue downwards, it will continue to till this point, will reverse and then take your entire trade out. In such cases, the best suggestion will be to, if you have missed a trend, don't worry about it. The market is going to move down, go back up, then come down again, go back up, and then come down again. So the good thing about such things is that if you have missed a particular trend, there's a possibility of another trend which will follow it. So if you have missed a particular trend, wait for the market to pull back, and once the market has pulled back, then only open the trade again. But the important thing is you must know where to open the trade, means where is the point where the market is going to reverse. This can be done in various forms. For example, you can plot some Fibonacci lines, you can plot some trend lines, or you can just observe the candlestick, which is also a good way. As you can see here, the market tried to make a go up. It faced a stiff resistance and lost a lot of pips here. Then it tried to open and go up again. It couldn't, then come down. So basically, this is an area where the market is getting a stiff resistance. It made a high, it made another high, it made another high. And afterwards, it reversed. So this is the place where you could have opened the trade. The ideal way could have been that you could have plotted a Fibonacci. I'm sure if this I plot here to here, this will be about 38.2 Fibonacci level, and this will be 50, this will be 61.8. So the best way would have been to combine the candlestick with the Fibonacci level, and then on the basis of that confirmation, you could have opened the trade. But the important thing is not to open the trade in the no man's land. If you have missed the beginning of the trend, wait for the market to pull back and then open the trade again.